Thank you, everyone, for joining us today. We really appreciate you taking 20 to 30 minutes out of your day to join us and talk a little bit about annuities. We have a wide range of folks on this webinar, I can tell. So hopefully by the end of the 20 or 30 minutes, you'll pick up one or two things. Some of it might be elementary for you. Maybe you'll pick up something that you didn't perhaps know. But the main thing is knowing that, honestly, that we're here to help you no matter what level you're at with the annuities, whether you've never written one before, whether you've written one or two, or you're just looking to maybe expand on the book of business that you currently have. So, next one, yep. Getting started, that's always the trigger, just how do I get started? How do I get going? Very basic. We have a great contracting department here, and they will hold your hand through the getting started. I mean, the actual getting started as far as correct licensing, make sure you have any requirements, including the E&O coverage that you have. Don't let anything, there's only 3 bullets there, but don't let anything on that slide intimidate you, because Jenny and Amber and people in contracting will make sure that you get where you need to be and any of the training that you need to legally sell any of our annuities. So, but again, the first step is kind of getting with us on that and make sure that you have the E&O and the suitability training and that kind of thing. But it is easy, okay? Some of the basics, and we're going to go over some terms. And I mean, it's going to be like a jigsaw puzzle, this beginning of this webinar, but just some key terms that you may or may not have heard of. Again, some very, very basics, but I hear guys, what's the difference between qualified, non-qualified? I've heard those terms before, but what exactly does that mean? You remember it however you want to remember it, but qualified means that it's qualified to be taxed at some point. Non-qualified, it is not going to get taxed, meaning on the principal. We'll kind of talk a little bit more about that. Qualified money is pre-tax money. It's like your 401ks. It's money that has never, ever been taxed by Uncle Sam. So at some point, they're going to want to tax that money, which we'll get to on another term here in a minute. The non-qualified, I mean, in simple terms, and it's not 100%, but simple terms, you might refer to it as bank money, like savings account money, or maybe money that had come from a CD, but money that you have already been taxed on. Not talking about any gains, but money that you have already been taxed on would go under the heading of non-qualified. So 2 just general terms, qualified and non-qualified. Okay, the next term there, 1035 exchanges or transfers. You hear that terminology some. So at the end of the slides here, we're going to have a cheat sheet on talking about transfers or exchanges. But in essence, all this is when a company or an entity, insurance company, whatever it might be, or an A.G. Edwards, whoever it is, a financial institution, is giving that money to the annuity company that you're writing for. So the yes column here, you can go from a non-qualified annuity to another non-qualified annuity. Perfectly fine. The second one here gets to be a little bit of confusion, but you can actually go from a life insurance policy that has cash value and move that cash value in to a non-qualified annuity. So shorten it down, you can go from life to annuity. Across the board there, kind of on the no column, qualified account to life insurance, cannot do that. You cannot go from a annuity to life. You can only go from life to annuity. And it comes up quite often. And we're here to help you with that, just to make sure that we can clarify. But you cannot go from an annuity to a life insurance plan. Okay, another term that you're going to hear a lot on, it's required minimum distribution. It's referred to as RMD. This has it's kind of been a moving target here as of late. That used to be 70.5 that the government would make me start taking money out of my annuity that is qualified. In other words, money that has never been taxed when I had hit 70 and a half, the government has a formula, an RMD calculator. You can Google all those things, but there's a formula that will tell you that I have to take out a certain amount of money for the government then to tax that. I can't just hang on to it till the end of time. That then moved up to age 72. And then recently here in start of 2023, they've actually moved it back to age 73. So any money that a person has in a qualified account, a qualified annuity, they're going to have to start taking a portion of that out to where it is going to be taxable income at that point. Okay. Another term that you're going to hear when we mention annuities, generally speaking, are surrender charges. Surrender charges, there's some annuities that are going to have some penalty-free withdrawals. Some annuities do not. If I enter into a contract with a insurance carrier that has an annuity, and it is a contract, if I quit that contract, there's going to be a penalty. So that first line that you see, policy year 1 at 9%, policy year 2 at 8%, that would represent in general a 2-year annuity. So in that line, if I was to quit 6 months into the contract, they would penalize me 9% to take any money out, whether it's a portion of the money or the whole thing. They would assess that penalty charge to me. The second line you see there, numbered 1 through 5, that's a pretty typical scale of a 5-year fixed rate annuity. So it goes 9, 8, 7, 6, 5. So in the 5th year, in this example, which is very common for any 5-year, in that 5th year, if I take out money that's not under a penalty-free category, they're going to assess me a 5% surrender charge on that, whether it's the full amount or any part that's not in a penalty-free account for that. So that's surrender charges. Okay, this is where we feel like we come in to help a little bit, because there's always questions on what fits your client. And we are mainly senior based, like many of you I'm sure are that are on this webinar today. And it's always the what fits the client. And we have a line of questioning that we can, of course, help you with, but we are also here to help direct you onto what fits. And you see down in the sub area there is Migas versus FIAs. So we'll start with the Migas, and that just simply stands for a multi-year guaranteed annuity. Some people are going to hear the term fixed rate annuity. Okay, this is if you've never written an annuity, this is a fantastic place to start. What you're looking at here with a MIGA or a fixed rate annuity is a guaranteed rate, and it's for a guaranteed set period of time. So bullet number 1, it is a guaranteed rate. Bullet number 2, they're offered typically from a 1-year up to a 10-year. Generally speaking, the sweet spot is anywhere from the 3 to 5 year annuity. So with that, I would have, if I wrote a 3-year MIGA, I would have a set rate, let's just call it 4%, for a 3-year period of time. No ifs, ands, or buts. It would be a set rate for the 3-year time. There might be, backing up when we saw the surrender, there might be some penalty-free withdrawals that we can access, and that's kind of product specific. MIGAs are they're really, I've been doing this now for 20 years, and they are they're great right now, even the real short-term ones. So I know the CD rates have raised a bit in banks and they're more competitive now, but I think you're going to see that the MIGA space has really escalated and upped their game, and you're going to see better yields than bank CDs. The difference too, one of the main differences, and we'll have a slide at the end, but one of the main differences is our MIGAs, they will grow tax deferred. So I put in principal $100,000 and I get 4% on that $100,000. So the next year I have $104,000. A CD would make me take that $4,000 in interest, and then I would work on that $100,000 again. But tax deferred means I can leave that $4,000 in. Now the next year, that 4% is going on to $104,000. So in a nutshell, it's a huge advantage of having a tax deferred growth vehicle. Okay, the next area that really we have here at New Horizons, this has been a big jump in our business, and this is the fixed indexed annuity, not to be confused with fixed rate or MIGA. This is fixed indexed annuities. Okay, these typically are going to run, and there's some exceptions, but typically you're looking at anywhere from 5 to 14-year contracts with these fixed indexed annuities. We feel like the typical sweet spot is 7 to 10 years. And these annuities are typically tied to an index. Some of them will have fixed rate accounts where I can allocate some money into a set rate for that 1 year. Some of these are exceptionally high right now. I've seen them as high as 5.5, 5.75 even on some accounts. But most of the time, people that are buying fixed indexed annuities will allocate their money and put them in some kind of an index component, such as the S&P 500 would be an example. Okay, we are here to help on this category because this is the big one. I mean, what's right for your client? I've got some generalities, and it's kind of what you see over the course of time. It's definitely not inclusive to what I have on this slide by any stretch of the imagination. And that's where we can talk it out on the phone a little bit to kind of see what your client's goals are. But what we see mostly on bullet number 1 there are seniors or older clients. Most of them are looking for a guarantee. Okay, so they're looking for that MIGA. They're looking for that fixed rate, that vanilla type product where it is a set rate, no ifs, ands, or buts. I'm going to earn that 4% or I'm going to earn that 5% over this amount of time. And it's set, it's easy to understand. And we find that a lot of our older clients really enjoy that type of product. Second bullet is sometimes you're going to come across clients that 4% just not real exciting for them. They're used to the market a little bit more. However, they might have been nicked up a little bit here on recent market production, but they are looking for something that might have a little bit bigger gains, not willing to really take huge risks, but want something that might perform just a little bit better. We would probably point or introduce then that client to a fixed indexed, an FIA at that point, and then we can kind of drill down on some allocations from there once we establish a product. This next one is pretty common. You'd be surprised how much we get on entry of people that have bank money, for lack of any further description, but they hate to tie up their money for a long period of time. They've been going to whatever bank it is, and man, that 1 year CD, I know it wasn't, it's giving me 50 basis points, but I may need that money. So we have a couple really competitive, especially right now, window annuities. Even though they are in a 5-year chassis, so they're within a 5-year annuity, they give you the opportunity to get out after 1 year, no penalty. So they call that a window annuity, where there's a small window here, typically a 30-day on the anniversary date, where that insurance carrier allows the client to say, you know what, this annuity really wasn't for me. I'm going to go ahead and take that money back out and put it wherever I want. But also with the window annuities, it does allow continuity to where you can continue with that annuity as well. Or you can take it out and put it in a different company altogether. So, but the point is, you get a person that doesn't want to tie it up for very long, we have an answer for that. And then that last bullet, a retiring person, but they want some growth for the next few years. But then after that, they're looking for a steady income. We have a couple really nice fixed indexed annuities they're really nice accumulator of growth products. And then at some point you can trigger the lifetime income rider. We have one that is exceptional that you can trigger it. You can take it back. You can trigger it again. So it kind of gives you a little flexibility on that part of it. Also on the one that I'm talking about, and you can contact me after the webinar or future dates, but we have one that it doesn't cost any money. You'll see a lot of income riders where they assess a small fee, but the one that I'm have in my head here, it does not assess any fee whatsoever. So it's a built-in feature for a lifetime retirement income rider, which is nice. Okay, so who is a good prospect? So not inclusive to this list either, but just some things to maybe keep an eye on. You know, people that have changed jobs and they have an old 401k, those are prime candidates because they still might be working. They just moved to another company. So they have to do something with their existing 401k, for instance. So if I'm working at ADM and then I move over to Caterpillar, sure, I can move my money that's managed there over to Caterpillar, but a lot of people are then moving it out to an insurance product, like a fixed index annuity, and then starting over at the new place of employment. So right out of our CNA, our client needs assessment, when you ask that question, have you changed jobs in the past 5 years? You'd be surprised how many people have, and they're just letting that money sit, and really there's no contributions being made to that money anymore. So that's where you can kind of come in and perhaps solve it. You're also going to have clients that have money in bank accounts that are getting next to nothing, and we would call that losing value. I mean, if they're getting basis points, which they have for many years, really that's losing value compared to where they could have their money. You can find clients that don't need to use money. They don't need the money right now, that they can kind of put it on the back burner. You can also, and I'm kind of skipping to the last bullet, this has been the big one here lately. We get retirees that they've taken a hit in these last couple of years in the market. So their 401ks didn't look near as good. So now they're looking to move it to some safety. So that's where you can come in and really help them, whether it's a Miga or whether it's a fixed index, but you can offer them some peace of mind. You can offer them a guaranteed rate with the Miga space, the fixed index. You can offer them safety where they would never lose any money like they have been in the market, probably of late or the last couple of years. So those are good qualified prospects to look for what you can help them with. Another one here on our CNA is, just asking them, and this is question 9 on our particular CNA that we have, client needs assessment, is just asking them if they're satisfied with their current return on their investments. And again, that kind of goes back to the bank money. Are they happy with that savings account money that's getting 0.5 basis point return? Or would they like to explore maybe something that would give them a little bit better return on that? And then when you ask that question, you're going to know right away probably if they're a bank person or if they have money in the market. So either way, kind of going back to what I just said, you can offer them some peace of mind with our products that we have, again, whether it's the Miga or the fixed index, but just asking is the biggest thing. So these most likely are your clients, whether it's a MedSup client or whatever they might be, but just letting them know that you can help them with safeties and in many places guarantees to start talking to them about their money. Resources. We have, and this is kind of how we're finishing it up today, but we have a lot of stuff on our website. We are happy to provide you with flyers, handouts, things of that nature when you're contracted with us with various carriers. But I have this on my whiteboard, annuity funding sheet. It's just a little cheat sheet, and don't let all the arrows fool you. We can get this for you. Again, if you're contracted with us, we're happy to do that. But kind of where the money originates as to where the money is going to go and how we get it there. So again, whether it's the transfer, and it's also in the language when we fill out apps, but whether it's a transfer, 1035 exchange, but this is one example of some of the education that we provide, or less headaches for you anyway. in the process of filling out apps. This one has been really popular. It's it's kind of comparing CDs with annuities, because annuity, when you talk to a person that's used to CDs or a bank, and you mention the word annuity, it could be a dirty word for them. They may associate it with a variable annuity where they've lost money, or they've heard of a friend or family member that had a variable annuity. They don't know the word variable. They just hear the word annuity. This little sheet right here, and I won't go into all the details of it, but it has been very, very, very handy for agents that are just starting out, especially talking to a MedSup client, perhaps that has, 20, 30,000 in the bank that's really just sitting there getting dust collected on it. That's just not getting any kind of return. And it's money sitting there that they really haven't touched for quite some time. So this has been a good little sheet to kind of go over and start talking to your client about money. This has been extremely popular, and we are going to expand on it now. We're going to expand on it to not only a 5-year annuity tip sheet, but we're going to go with a 3-year. There's so many 3-year Migas out there right now that are extremely competitive. I mean, their rates are very comparable to the ones you're going to see on a 5-year tip sheet. We could make this thing so much fancier, I think, and we've bounced off different ideas, but we want it bread and butter. I mean, we want it meat and potatoes. I can see the company, I can see the rating, I can see the rate. Those are the biggies. And then we might have some withdrawal information or just some key feature information. But we honestly feel on our tip sheets, less is more. It's kind of where I'm grabbing some information in a quick fashion. We have individual company rate sheets that really drill down on more of the features of that particular product. We have quick sheets on each product that are available, but that would defeat the purpose of what you're looking at right now. You can get on our mailings or emailings, many of you on this probably already are, and you're going to receive this. There for a while, we were driving Jason and Rebecca crazy in Kachina because companies were changing rates at a rapid pace. So anytime there's a change, you're going to get a new rate, a new 5-year tip sheet, and then now it's going to be a 3 and a 5 continued on with this. But we feel this is a great service that we offer. It might not seem like a lot, but we get a lot of compliments that it's kind of cut to the chase. What do we have now? Kind of a deal. And it also keeps you in the know, because when there's rate changes, you want to make sure you're right. And also our website is kept up to date as well. So that is pretty much it. You can type in any questions you might have. Again, I don't know everyone that's on the webinar today. I had an agent that has been in the business longer than I have, and I've been doing it now for 20 years, which seems like a long time. Jason came here when I was 15.
Yeah.
So, but he is an ultra successful agent. I mean, ultra successful. I'm going to guess 2,500 MedSups clients. And he's coming in now. He's coming in and he's just going to do the Migas. I mean, set rate, set period of time. I personally feel if you've never written an annuity before, that is a fantastic place to start. And I can tell you these rates are fantastic right now. They are phenomenal. We can illustrate for you even, if you want to look at it yourself, if that's something that would help you. We are here to make life easier for you. We are here to help you help your clients. I don't care how corny that sounds, but if we can help more people, especially right now when there's some volatility in the marketplace and you have some good existing clients already that they don't even know you can help them with their money, that they have, again, the money sitting in a bank or in the market, where you can help stabilize and really have a benefit for them that they didn't even know that you might exist. And again, we're not going to solve all this on one 20-minute webinar, 30-minute webinar, but my contact information, you'll see it on the slide or on our website. Feel free to call me, to email me, however you want, and we can get a conversation started and just try to take that next step. I think we have some questions popping in there.
Yeah.
I can't read them, but
Yeah,
you can.
so David's asking, what carrier do you use for a window annuity?
Two carriers that come to mind right now is KSKJ Life. I am hesitant. I don't know what state you're in, David, but they are in limited states. So that would be something you would want to check with us. But I know right off the top of my head, their window annuity rate is 3.25. For 1 year, it's locked in like that. But again, I'll caution us all that that particular carrier is in limited states. We do have another carrier, Elko Mutual, that is in all states, except for a couple. And they do have a competitive window annuity as well. So those are the two that come to mind. Not a huge market on that particular one, but we do have some outlets for that.
Okay, Donald wants to know what the commission rate is on a MIGA.
Yep. So Migas, and again, you can get with me, Donald, on that, because there are so many variables on this, because age matters, the product matters, obviously the company matters. But let's just talk about, in general speaking, on most 5-year MIGAs, generally speaking, and again, age matters because there are some haircuts involved with older clients, and that means cutting commissions. But generally speaking, you're looking anywhere from 2% commission to 2.7, 2.8%. And again, depending on carrier and age of client, generally speaking.
Okay, if you sell a MIGA to a 65-year-old and the annuitant is not required to make RMD withdrawals each year until age 73.
That's the way it stands right now on qualified money. And if I can add on that too, RMDs only come into play with qualified money, with money that's never been taxed. There are no RMDs on non-qualified annuities. But to direct answer your question, if you put them in a 5-year, the RMDs wouldn't be a factor. Correct.
Okay, Scott asks, aside from current clients, is there a steady annuity lead source available, direct mail, Facebook, internet, etc.?
You know, we don't have leads for that particular market. Obviously, the best leads for a lot of our agents are the ones that are in their filing cabinets right now. With that said, I know of guys, because I talk to guys, multiple guys a day, that will do Facebook. Here's where I'm going to caution you. When you get out in social media and you're talking about annuities and that kind of space, there are compliance issues. And you don't want to get on the wrong side of any of those, where you're advertising a carrier and you didn't get permission, or you falsely claim something on that. That leads to fines. So be careful on anything with that. Check with us or the carrier, the particular carrier, so we can really hold your hand. I know guys that take ads out in paper. I know guys that have success when they do general education for Medicare or annuities. And again, you know, when you're advertising these, you want to make sure you're compliant. You don't want to get on the wrong side of that where you're not compliant. It can lead to a fine. There are lead vendors out there. You know, that's always the $1 million thing is how do I find customers? No doubt about it.
Okay, Tyler, how does it go if someone gets a 3-year fixed rate annuity and that 3 years comes up and they don't do anything different with the annuity? Does it just roll over into another year?
That is a great question, Tyler. That can happen for sure. So we have a carrier, and I'm just going to name them right now, Liberty Bankers Life. They have a 3-year annuity right now that's at 4.9%. And we love a lot of carriers. They are we love this carrier. And so to answer Tyler's question, each carrier is a little bit different, but on this carrier, you can do an internal exchange. In other words, rewrite the business into that same 3-year plan, or maybe you're moving it to a 5-year plan, and they're going to pay you full comp. You can also, on many carriers, not do anything, and they'll just be rolled into a renewal rate, which would be less than what they're currently receiving. And then there are other carriers, so it's kind of carrier by carrier, that will automatically renew them into the same product that they currently have. They will then pay the client or the agent without doing anything, typically half the comp is what they will do. So you have to pay attention. I'm not going to give a blanket answer because each carrier treats that a little bit different, but it's something that you want to pay attention to, whether you're using like an agency block or whatever kind of a management system. You're going to want to know when that comes due. Typically, the client's going to receive a letter 30 to 60 days out, as should the agent receive that same letter to let you know that renewal's coming up. So it kind of gives you a warning to what's going to happen. So Tyler, they can renew it themselves internally, get paid some, but again, you just want to pay attention to that.
Okay, Courtney, which carrier or product were you highlighting about the income rider with no fee starting and stopping?
That would be Silac, a company that we have a great relationship with. The particular one that I had in my head it's called Denali. We write a ton of that. We put in several million last week just with that product alone. Specifically speaking, and you can get with me later on that, Courtney, but specifically speaking, that's a fixed indexed annuity that is either a 7-year, a 10-year, or a 14-year. And they also have a bonus line with that particular annuity. But it's been exceptional. It's been a big ticket item for our agents.
Okay, and someone's asking, are qualified annuities subject to RMD after age 73? I think
Yes, they sure are. So at age 73 now, with the new legislation that came in, they are subject. Money that has never been taxed by our government, they're going to make them take out a portion of that money, and then that's a taxable event.
Okay, and Pete asks, how often do I need to complete the 4-hour annuity training?
I'm going to defer that one to Jenny, and she's our contracting director, but you have to, it's an initial class. So you've taken that. I'm a licensed agent myself. I sell annuities, still do. It's not my job, but I still do it. You will then each year be responsible, and I get on LIMRA website to keep my AML, my anti-money laundering, costs $0, but I have to keep it up to speed. So it would be my understanding, and Jenny can correct me, but I would have the one class, the 4-hour that you're alluding to, and there's some states that are different. So I caution even myself in answering this because some of them are longer than 4 hours, but I have that the one time. But then as long as I stay current, I don't have to go back and repeat that process, that I stay current on my AML after that. Is that all the questions?
Yeah.
Okay. I know we didn't answer everything today probably, but please, I hope you feel welcome to reach out to me for help. We are here. I love helping somebody that's never written an annuity ever, and that they want to get going on it, and we have some ultra successful agents I know on this webinar right now. And just how do I get started? And I promise you, everybody had to start one way or another. And once you get the hang of writing, and again, I'll start with the Migas, 1 or 2 or 3 of those. And here's a common thing. Oh, I don't want to hurt my client. We're not going to let you hurt anybody. We're going to review everything, make sure that we're putting your client in the best possible position, make sure they know what they have. And again, corny as it sounds, if we can just keep helping people, we're all going to benefit from it. You're going to benefit in compensation, and it's very healthy compensation, but you're going to benefit most because you're helping your people. So thank you, everybody, for coming in. Everybody that's on the call, any of you who've written business, we certainly appreciate it. Any of you that haven't, we welcome the opportunity to earn your business and do what we can to help you. Thank you, everyone.